So, again, my name's Kellyanne Worthington. I am a senior loan officer with Cross Country Mortgage, and today's topic that we are going to discuss is mortgage interest rates and how they work. I will then post this to my YouTube channel and then to my Facebook page. You're welcome to go there and comment on Facebook if you have any additional questions. And always, as you know, you can reach out via phone call, text, or email with any questions outside of this meeting as well. So first, let's talk about why understanding rates matter. So rates can impact your monthly payment, but not necessarily by what you think. It can also affect your purchasing or buying power, but not by how much you think sometimes. A lot of people think if their rate is a difference of 0.5, that it's going to save them hundreds of dollars in a month on their payment when it's actually a much smaller portion. So we'll give an example of that. The goal from today is to understand how do rates work and what affects them. And then just one of the things I always find very interesting is to talk about is that did you know that you could have two borrowers that are starting at the same time and applying for the same loan type with the same purchase price on the same day at the same time from the same lender, and they'll both have different rates? I just realized I wasn't sharing my screen. So now we're going to do that. Okay, there we go. Okay. Sorry for the technical difficulty. Okay, so what is a mortgage rate and how does it work, right? So mortgage rates are the cost of borrowing money. So when we talk about an interest rate, it's actually the cost of the money that you're borrowing. It's expressed as a percentage and it's paid over the life of the loan. So an example I'm going to give you is for a $300,000 loan at a 6.5% interest rate. So on a $300,000 mortgage loan, if your interest rate is a 6.5% fixed interest rate over a 30-year time frame, then your monthly principal and interest payment would be approximately $1,896. The total paid over 30 years between your principal and interest for borrowing the $300,000 of money that you didn't have to buy the home in cash would be $682,560. And the total interest that you would pay out of that is $382,560 of interest. So this is why it's broken down to show you that even though you're getting a home for $300,000, you're actually borrowing. If you stayed in that home for 30 years, you'd be borrowing and paying out $682,560. And I promise I'll get through the speaking part, apparently having a hard time with that today. So what is principal and what is interest? So principal is the amount of the payment that you are making that is going towards actually paying down your loan amount. So every month, every year throughout your 30-year, for example, if it's a 30-year loan, every month, a percentage of your payment of the principal and interest is going towards the actual loan pay down. And then a percentage of it is going towards interest. Interest is the amount that gets paid to the creditor lending you the money up front that's covering the risk and funding the loan. So that's the difference. Now, at the beginning of a loan, when you start a loan, a majority of your principal and interest is going towards interest. And then after you get to about the middle mark of your 15 year, of the 30 years, at the 15 mark, it starts to shift and more is going towards principal and less is going towards interest. And we call that an amortization schedule. And when you purchase a home, one of the documents that will be in your closing package is that amortization schedule that will show you every single month, every single payment, how much is going towards principal, how much is going towards interest, so that you can see what you're paying out to who to buy down, not buy down, but pay down your loan amount. So there's two types of rates, right, as standard practice. There's fixed rates and there are adjustable rate mortgages. So a fixed rate mortgage, the rate stays the same throughout the entire life of the loan. So it's locked in, it's never going to change. So that means your rate stays the same, your principal and interest payment stays the same. It allows for predictable payments, and the common terms are 15 and 30 year. However, there are 10-year, 20-year, 25-year, etc. But 15 and 30 are the most common of the types of year terms that people get with mortgages. Then we have adjustable rate mortgages. Adjustable rate mortgages, or ARMs, are an initial fixed period where the rate could be lower, but then the rate is going to change. The rate will flex with the market. So sometimes it might go up, sometimes it might go down. It's a much higher risk loan option, and it is best for short-term home ownership cases. So let's say your kid's about to go off to college and you know that they're going to be there for 4 years, and rather than staying in a dorm and the cost of the living on campus, you want to do a short ARM loan to purchase a home that you know you're going to keep for 4 years and then sell. Or you're a doctor and you're moving to a city and you know your contract for your employment is a 4 or 5 year term loan employment there, right? So that would be a great example of why an ARM might be great. You might get that lower interest rate at first, but know that you're going to move before those rates start to go up after that set fixed time period. ARMs typically have a balloon payment at the end, which is a very large lump sum payment. They are much higher risk. So typically for most home buyers, you are going to want to make sure that you're looking at fixed rate mortgage options. So how mortgage rates are determined? They are determined by the financial markets, right? So everybody always likes to call lenders and be like, what's your rate? We don't have rates, borrowers have rates. So it's not the lender's rate, it's your rate that you're getting for your file based on multiple contributing factors. Things like your loan type, your down payment percentage, your debt to income ratio, your credit score. Do you have more than one borrower on a loan? Because that changes the risk factor. What property type are you buying? What is your area median income for, like, what's your income versus the area median income for the area? Because there are programs that allow people who make under 80% of the area median income, sometimes a discounted rate for their mortgage rate or their mortgage insurance. So borrowers are the ones that have a rate based on their specific file. Now, also mortgage rates are determined by investor demand. And what does this mean? So sometimes investors are looking for fixed rate 30-year mortgages. Sometimes they're looking for fixed rate 15, or sometimes they're looking for ARMs. So whatever is happening in the secondary mortgage market and what that market is looking for to buy and sell also affects the rates that borrowers can get based on the demand of those products with the investors. Economic conditions. So this one is very prevalent right now. So about 60 days ago, let's say, rates were gorgeous. They had continued to come down. We were getting into the high fives, low sixes, and then a war started. And all of the stuff that is going on between our economic situation, the global economic situation, the risk of all of that affected things, and rates came up. Then we have inflation happening, and we'll talk about that in a little bit. And rates came up. So rates now, compared to 60 days ago, are very, very different. So everything going on, not just in your own loan file, but in our economy and in the global economy, can affect mortgage rates and what rates were being quoted for you as the borrower based on what's going on around us. And then risk assessment of the file. A higher debt to income ratio or a lower credit score is going to be a higher risk factor, which will affect your rate. So all of those things are things that go into what rate you are given for your specific loan file as a borrower. So the bond market and mortgage rates. So what is the bond market? The bond market is where mortgages are sold, and they're called MBS, mortgage-backed securities. So mortgages are bundled and sold to investors. And a lot of times I will have clients call and they'll say, well, you're going to keep my loan, right? You're never going to sell it. If any lender tells you they're never selling your loan, they don't know that, right? So most loans are always going to get sold at some point during their 30 years out into the secondary mortgage market. All servicers, all people, lenders who back loans, et cetera, are allowed to keep a certain amount of portfolio of own loans in their pocket, but most of them are going to be sold out into the secondary market. That is what is the whole process out there of the buying and selling of loans. So mortgages are bundled into packages of, what the investors are looking for in the secondary market. So what they are looking for influences those pricings of the mortgage-backed securities. You also have the 10-year Treasury yield influence. So the yield is the return investors are earning for buying 10-year Treasury bonds that are issued by the U.S. government. Because the bonds are a safe investment, they serve kind of as a benchmark for other interest rates, including mortgages. So that 10-year Treasury yield really can influence the rates that are going on for mortgage rates for buyers. And then why it influences mortgage rates is mortgage lenders and investors compare mortgage-backed securities, the MBSs, to the Treasury bonds. And so all of those things, just like the economy, what's going on globally, all of them affect the daily rates that are out there in the market. And it's important to understand that mortgage rates change every single year, every single day. So even if we talked at the beginning of the day and you were ready to lock in your rate, but then you weren't quite sure and you wanted to check on something and you called back later in the day, the rate might be different because it goes right along with the stock market, and those rates are updating all day, every day, Monday through Friday. So it's important to know that rates change daily. So the Federal Reserve and inflation. So this is one of the things we heard a lot when the Federal Reserve cut the Fed rate. The Fed rate isn't mortgage rate. So if the Fed rate drops by, say, 0.5, it doesn't mean mortgage rates drop by 0.5. So the Fed controls the federal funds rate. The Fed does not directly set mortgage rates. Inflation is a very high indicator of what is going to happen with mortgage rates because inflation usually pushes rates higher. Higher inflation means higher mortgage rates. Lower inflation equals lower mortgage rates. And the reason why is because investors demand higher returns when inflation is high. Their money loses their purchasing power. So the higher inflation is, the higher the rates typically are going to tend to be. Credit score impact. So this is a big one. Your credit score does impact what your potential interest rate is going to be. So the higher your credit score usually will mean a lower rate, but not always. And what's an example? So with conventional loans, there are things called LLPAs, or loan level pricing adjustments. What Fannie Mae and Freddie Mac do is they say, okay, we've got this borrower with this credit score, this much percent down. We're going to give them a hit of this much on their rate because we know they want our loan. And so we're going to charge them more because we know they'll pay it. So just because you have a high interest rate doesn't mean you're always going to have the best rate. But typically, the higher your credit score, the better your rate or your cost of the rate is going to be. It lowers the risk for lenders the higher your credit score is. So that is why it typically, not always, but typically will have an impact on your rate. But the important thing, whether it be credit score, debt to income ratios, et cetera, that affect your rate, the one thing you don't want to do is say, well, I'm just going to sit here and wait. Even though I really need to buy, I'm going to just try to keep improving my credit score because it's going to make this significant impact on my rate. It might change your rate by 0.1 or 0.25. It's important to understand that just sitting there waiting for years to try to get your credit score from a 620 to a 700, could it make an impact? Yes, but do you want your home? So if you're sitting there knowing you want to buy, you can always refinance down the road. If you're wanting to stay in that home for forever, when you get a higher credit score, you just don't want to stop yourself from getting your dream of home purchasing just to try to get a perfect credit score, because it doesn't always make as big of an impact as you think it does. So it's just something to keep in mind. Now, your down payment and LTV or loan to value are other things that can affect your rate. So, larger down payments typically will obviously reduce the risk. So, typically, the larger you go on a down payment, you're most likely going to have a better interest rate. However, that's not always the case. An example is there are first time home buyer programs out there where a first time home buyer is only putting 3% down, right? But they are going to have a better interest rate than a borrower putting 10% down. So it's important to know that just because you're putting more money down does not always mean that you're going to have a better interest rate. Sometimes 20% down is better than 10% down, but sometimes it's not. Sometimes they have the same rate. Sometimes, you might put 30 or 35% down. That has a much more significant impact on a rate than going 10 or 20. So it just always depends on the borrower's file and what the market, like we talked about before, is looking for to determine what those rates are going to be that you're quoted for your file. And a lower LTV can improve your pricing, which LTV is loan to value. So the higher your down payment, the lower your loan to value is. Just a strong borrower profile will always impact your rate. So let's talk about different loan types. Not many people understand that different loan types have different pricing. So just because you have your file, right? You've got your DTI, you've got your debt to income, you've got your down payment, you've got your credit score. Some borrowers think that that means no matter their loan type, the rate's going to be the same. And that's actually not true because you have different investors in each one, and your rate is going to be different in every loan type. So a lot of times people don't realize FHA actually most of the time, not always, but most of the time will have a lower interest rate than conventional a lot of the time does, right? Now, the benefit of a conventional loan is it's going to get rid of mortgage insurance after 20% of the loan is paid off, where FHA typically, unless you're paying more than 10% down, which most FHA borrowers don't do to save money, that mortgage insurance is going to be on there the life of the loan. But the conventional, typically for Freddie Mac, they want 620 or higher on your credit score. Fannie Mae wants, well, now they got rid of the credit score requirement. They just care about all the indicating factors on your loan file, money, debt, etc. But typically, conventional overall will have the best rates available for borrowers. But like I said, sometimes FHA will have a lower interest rate than a conventional loan. So it's not always. The benefit to FHA loans is they allow much more flexibility with credit scores. So they typically can go as low as 500. But again, your rate is drastically going to be affected if your rate's below 600 versus above it. VA loans and USDA loans offer competitive rates. VA loans are only available for eligible veterans. USDA loans have similar rates to FHA and VA, typo, but they have the highest credit score requirement, and they also are property specific. So your property has to be within a USDA area to qualify for those rates in that loan type. Loan terms. So typically, the two main loan terms, like we talked about, are 15 and 30 year. A 15-year loan is going to have a lower rate, but you're going to have a higher payment. However, a 30-year loan is going to have lower payments, but you are going to pay double the interest over the life of the loan. So sometimes if you know you can afford a higher payment, it's worth doing a 15-year loan instead of a 30-year loan because you'll have a higher payment, but you're going to pay the loan off 15 years earlier, and the amount of interest you're going to pay is much less, and your rate is going to be lower. So you don't always have to just look at 30-year loans. If you have the income capability to do so, you can also look at, for example, a 15-year loan and see what the rate difference is and what the payment difference is. And if it's a payment you're comfortable with, it can save you hundreds of thousands of dollars. Like that example we gave earlier on a $300,000 loan, you're paying almost $360,000 of interest over the 30 years. So cutting your loan into a 15-year, if you can, financially, can definitely save you hundreds of thousands of dollars. Occupancy and debt to income ratios. This one is a big thing. So primary residence purchases are always going to have the best interest rates. If you are purchasing a second home or an investment property, those will always be much higher interest rates than your primary residence purchases. And they typically have a cost to the rate or points that are required on them compared to primary residence purchases, which typically have a par rate or a no cost rate for borrowers unless they choose to buy a rate down. It's also important to know that your property type will affect your rate, not just your occupancy reason in your file. So if you're buying a primary residence to move into it versus an investment home, different rates, but also your property type can affect that as well. So a single family home is the least risk purchase price capability property type. It is always going to have the best rate. The second you get into manufactured homes, condos, or multifamily homes, the rates are immediately going to be higher because they have a higher risk. And a lot of times people are like, well, what's the risk? Well, a manufactured home isn't built typically into the ground. So if there's a storm, high winds, etc., it could affect the safety and soundness of the structure. With a condo, you have multiple factors of risk, one being your HOA fee, which could change at any point by the HOA and all of a sudden make you not be able to afford living there and potentially default on your loan. You also have other people sharing the outside walls or above or below walls with you, and what they do in their properties can affect the safety and soundness of your structure. So it's a higher risk. And with multifamily homes, you could have tenants that are in a property that you're sharing one side with, or multiple tenants into both sides, etc. All of that determines the risk factor of the property, which can increase your rate for your loan. Okay. Lower DTI, like we talked about, often improves price sensing. So when you put more money down, typically you're going to have a better rate, but not always. What are discount points? So a lot of people ask me, well, what are points? What is this cost to a rate that people talk about sometimes? So discount points are an optional front fee that you can lower your interest rate or buy down the rate if you have the money to do so and you choose to do so. It is important to understand the cost versus savings discussion that you need to have when looking at buying a rate down. It's also important to know that you can't just buy the rate down umpteenth percentage points, as much money as you would like to spend to buy the rate down. There are rules and regulations of the Mavent high cost test, et cetera, that the government determines the exact percentage of cost that you are allowed to incur as a borrower, even by choice, to buy your rate down. So I wanted to give you a mathematical example because I think this highlights and shows the decision-making process if you have the additional funds to buy a rate down, why it sometimes can be beneficial to do so and when it isn't smart to do so. So let's say you have a $200,000 purchase price and you're a first-time home buyer and you put 3% down and you have $100 in homeowners insurance, $300 a month in monthly taxes, and your mortgage insurance is factored in. At a 7% interest rate, let's just say that's what it comes up with. 7% is your zero cost par rate, no cost for the rate. Your payment is $1,739.19. Now, let's say you say, Kelly, I would like to buy my rate down to 6.5. And I go, okay. And I go into the rate program that is from the secondary market. It shows me the rate options. And I say, okay, at 6.5, the market is quoting you 1 point. 1 point, just so you understand the math of it, equals 1% of the loan amount. So at a $200,000 purchase price at 3% down, it means your loan amount is going to be $194,000. So when you take $194,000 times 1%, the cost for that 1 point to drop the rate from 7 to 6.5 is $1,940. And your payment is going to now be $1,674.71. That's a difference of $64.48 a month. Now, here's how you determine, is it worth it to do this or not? You take the total amount of the cost, which is $1,940 in this scenario. You divide that by the $64.48 difference in the payment, which equals 30.08, and you take that number divided by 12. That means the number is 2.5. It's going to take about 2.5 years, give or take, for that amount of money that you just spent up front at closing, because that's when it gets paid. It cannot be financed to buy down the rate. You have to pay that money as part of your total cash to close. So that means that $1,940 that you added to your total cash to close is going to be paid off within 2.5 years of your monthly payment difference that you're saving, right? The rule of thumb typically is that if it's under 5 years, and you know you're going to be there 5 years or longer, and you have the funds to do it, sure, go ahead. It's a financially okay decision to do so, because in this example, it's going to be done and paid off. That money that you saved is going to be paid off after 2.5 years of making those payments. Now, let's say that mathematical equation came out to 6.3 instead of 2.5. Then we typically wouldn't recommend doing that. It's better to then wait, refinance when the rates come down or when you have more money saved up than to do it now, right? So you always want to kind of take a look at, is it smart to buy down the rate, or should I just keep my payment where it's at and then refinance down the road? Or I know I'm not going to be in my house for, 5 years. And so this is kind of my starter home. And so I don't want to buy the rate down right now. I'd rather just wait, and then I'll sell my house. And then, or you're going to stay, but rates are going to come down over the next few years. And you're like, I'm just going to wait and go ahead and get a lower rate when I refinance down the road or when I sell my home. So that's what it kind of breaks it down for you. Now, market conditions and timing. So it's important to know things like your inflation report, your jobs data, your Fed commentary, global events and investor reactions. All of these are going to affect your market conditions and timings for the rate that you're going to get. And what do I mean by that? So like we talked about with inflation, the higher the inflation, the higher the rates. The lower the inflation, the lower the rates. So just know that as you see the news reports of what's going on out there, that can affect your rates with what is happening with inflation. Jobs data. If we have a really good job report or not, that's going to affect what's going on in our economy, which again, the economy affects rates. The Fed commentary, if the Fed is lowering the Fed rate, that could have a positive effect or no effect. So the things that the Fed does can affect your rate. And then global events. So when we make choices that affect the world, that can negatively impact our interest rates, which is what we're seeing right now. So it's important to be aware of those things that are going on and understand how they can impact your purchasing power. Rate locks. So when you go to get pre-approved, it's so important to understand that you don't have a rate. So when you get pre-approved, there is no rate. There is an estimate. And the reason why is you might go get pre-approved and buy and get an accepted offer in a few days. It might be months. The rate might change. So when we do pre-approvals, a lender typically will put an estimated rate in there and go a little bit higher than what the current rate is, because rates aren't fluctuating up and down 1 point over months. They might change by 0.1 or 0.25 or 0.3. They're never changing like a whole point in 1 month, right? So they typically will do an estimate, and that covers you for when you're out there putting offers in. Once you have an accepted offer, the lender then can either talk with you over the rates and what's going on, and then you can choose whether you want to lock your rate or whether you would like to wait. You can typically wait until up to, the safe answer I always give is 7 business days prior to closing to lock, because you have to lock, and there are certain documents that have to go out, and there's a 3-day rule for the final closing disclosure, which can't go out until the day after your rate is locked, minimum. So I always say 7 business days prior to close is typically the last day that you want to wait to lock rate, if you're going to choose to wait and risk that, right? Common lock periods are between 15 to 60 days, but some investors will allow up to 90 days. It's important to know that the longer out you lock your rate, right? So 15 versus 30 versus 45, 60, 90, the higher the cost or the higher the rate is going to be for that rate lock. So you locking at a 15-day rate lock is different rate than you locking sometimes at a 30 or 45. So the lender's job is to look at what's on the market when you're ready to lock, and tell you, okay, here's what we see. The rate is at 15, 30, 45, 60, etc. And then you can decide, are you ready to lock when you get your accepted offer? Or do you want to wait and see what the market does? I'm not a big risk taker, so I tend to just want to, I've got my accepted offer. I know here's what my rate's going to be. I lock it in and I'm good. That way I know I'm set. Some people are risk takers and they wait. So it really is just a personal preference for you as the buyer on when you want to lock your rate in. So that covers all the basics. There's so much more that goes into it, but I wanted to just keep it simple and to the main things that affect rates globally in the US and then you as a buyer. So I hope you found that information helpful. As always, you can reach out to me. I am available 7 days a week, 8 a.m. to 10 p.m. You can call, text, email. My QR code is there to scan for my virtual business card that has all my links and information. And I hope you all have a great rest of your day. Thanks so much. Bye.